What if I told you that you only need two ETFs to build a powerful long-term portfolio? That's right, just two tickers, IVW and IYW. In this video, I'll break down why these two funds complement each other, how they cover both growth and tech innovation, and why together they could be a complete portfolio solution for many investors. Stick around because by the end, you'll see why these two might be all you need. Most investors get overwhelmed by the sheer number of options out there. Dividend funds, growth funds, sector funds, international funds, you name it. But having too many choices often leads to decision paralysis or spreading yourself too thin. The truth is, you don't need 10, 15, or 20 different positions to build wealth. In fact, keeping things simple can often deliver better results. That's where IVW and IYW come in. Together, these two capture the essence of the U.S. growth story: broad exposure to leading companies plus concentrated access to technology, the engine that's powered much of the market's returns over the last 2 decades. Let's start with IVW, which stands for the iShares S&P 500 Growth ETF. This fund comes with a very low expense ratio of just 0.18%, so you're not losing much to fees. Instead of holding all 500 companies in the S&P, it zooms in on the growth side of the index. The companies showing faster sales, stronger earnings, and higher valuations. So rather than heavy exposure to banks, utilities, or energy stocks, you're leaning into names like Apple, Microsoft, Amazon, and Nvidia, the real engines of U.S. growth. Think of IVW as your core growth foundation. It gives you large, established, high-quality companies with strong balance sheets, but tilts toward growth rather than value. It's broad, diversified, and covers around 250 companies. Now let's move on to the second piece of the puzzle, IYW, the iShares U.S. Technology ETF. This one has a slightly higher expense ratio at 0.39%, but for what you get, it's still very reasonable. Unlike IVW, which spreads across multiple growth sectors, IYW is laser-focused on technology. Its top holdings include giants like Apple and Microsoft, but it also brings in software companies, semiconductor leaders, IT service providers, and communication tech firms. So why add IYW if IVW already has tech exposure? The difference is that IVW balances tech with other growth sectors, while IYW dials tech up to the maximum. And since technology has been the biggest driver of U.S. market returns over the last decade, many investors want that extra boost. Think of IYW as your growth accelerator. It amplifies your exposure to the most innovative and fast-moving sector in the market. Here's where things really click. With IVW, you're getting broad growth exposure. It spreads your money across healthcare, consumer discretionary, communication services, and yes, plenty of tech. With IYW, you're doubling down on technology, the sector that's been leading innovation and delivering huge profits. Put them together and you've got what I'd call a barbell approach. On one side, IVW gives you balance and diversification. On the other, IYW ramps up your exposure to the fastest growing, most disruptive part of the market. This mix keeps your portfolio simple. Just two ETFs, but still powerful. You've got a reliable foundation plus the extra horsepower of tech. It's like having a solid engine under the hood while also bolting on a turbocharger to push performance even further. All right, so let's talk numbers, because performance matters. Over the last decade, both of these ETFs have delivered some impressive results. IVW has averaged about 15.75% per year. IYW has gone even further, with roughly 21.65% per year. To put that into perspective, both of them beat the broad S&P 500, and IYW especially stands out thanks to its heavy tilt toward technology. Now, of course, past performance doesn't guarantee future results, but history makes a pretty strong case here. If you had held these funds for the last 10 years, you would have captured a lot of growth, especially from the tech boom. Of course, no strategy comes without risks. With IVW, remember you're leaning into growth stocks. That means when value stocks or cyclical sectors have their moment, IVW can lag behind. And with IYW, you're doubling down on technology. That's great when tech is on fire, but it also means bigger ups and downs. If the tech sector takes a hit, you'll feel it in your portfolio. One way to manage that risk is by adjusting how much of each fund you hold. For example, keeping a larger percentage in IVW and a smaller slice in IYW gives you more balance while still maintaining tech exposure. If you want to be more aggressive, you can tilt heavier toward IYW. But if you want stability, lean more on IVW. So while this two-fund setup is simple and powerful, you have to be comfortable with some extra volatility along the way. So who's the right fit for this strategy? If you're an investor looking for a long-term, growth-focused portfolio that doesn't require juggling a dozen different funds, this could be it. It's also a great match for people who believe U.S. large-cap growth and technology will continue to drive the market forward. And honestly, if you just value simplicity, because let's face it, not everyone wants to manage 8 or 10 ETFs, this approach keeps things clean and manageable. The key is being comfortable with some ups and downs. If you can handle that volatility, IVW plus IYW might be all you need to build a powerful, growth-oriented portfolio. So there you have it. Just two tickers that, together, can give you a complete, growth-powered portfolio. Diversified, simple, and designed to capture the best of both worlds. Broad growth and cutting-edge technology.